as a stock picker, you gotta. I'm not spending all this time doing research to get an 8% return.
No. My take is that, okay, I'm looking at this dividend. I think that the stock will regrade if they can't keep up with their dividend. Okay, so and the valuation will come down. I'm not saying it's not investable, but I'll probably look at this, once they're in a, Canadian dollars, $14 ish. But
I really don't think the average person should be picking stocks. And if your thesis for AQN is that it's low risk, I think you need to revisit that thesis.
Yeah. Everyone, welcome to the 6th episode of the Canadian Investors Podcast. Today I'm joined by Tom and Nate. Jake unfortunately couldn't make it, and today we have something special. Instead of talking about a stock we own, we're talking about a stock that I no longer own, and why we're not buying. That doesn't mean that. And the company name is Algonquin Power. It doesn't mean this is a bad stock, a bad company. We're just gonna go ahead and talk about why I sold, and why maybe Tom and Nate maybe a little bearish on it.
Yeah.
Right. So let's start with the introductions. And viewers can skip this if they wish. But I'm Kuhn. I'm a accounting professor. And my training is obviously in accounting. I was a CPA and auditor, and I use my accounting training to help me understand if the companies are on track to achieve their strategic goals. Right. I usually focus on growth companies. The reason why I owned Algonquin is because last year the indices were pretty high, so I was a little bit tentative in adding to my growth positions, fearing a fall. So I diversified, but I no longer own this stock. So I'll back to you, Nate.
Yeah, I am a school teacher. Currently, I teach grade 8. I am interested in value investing, specifically from a quantitative perspective. And I actually came very close to buying AQN for the very reason that Kuhn suggested. I thought the growth stocks were overvalued last year, so I started to diversify into dividend stocks to add some safety and diversification to my portfolio. But I could never pull the trigger on AQN for reasons I'll talk about today.
Yeah, my name is Tom, and yeah, I'm also a retail investor. I lean a little bit more towards growth, and there are certain things that I look for in stocks that I don't see in this company. And again, we're going to go over all of that when we talk about it, because this is a very popular stock, I think, within the Canadian fixed income space or retail space and stuff like that of Canadian dividend investors.
Yeah. I think it was also a darling of the value community for a while, but it really look like a value play right now.
Right. Okay. So actually, let me share the screen instead. So we'll have the clearest representation.
I like how your presentation is why I closed my AQN position. I'm also, I want to claim, partial responsibility. This is probably not true, but I teased you a couple of weeks ago on this podcast for owning AQN, and you sold it. So
yeah, I'm certainly, always listening to.
I'm just kidding. Yeah. I'm sure Kuhn makes his own.
I welcome that advice. So, all right. So, and today, we'll also talk about stock rotation and energy if we have time. All right. So what's my investment thesis? And for your information, I had 500 shares of AQN as as recent as 2 weeks ago, and I decided to leave 1 share as the tracking position. And my reason for investing in this is was a renewable energy play. I do see this as a long-term trend. It does take some time to play out, and I just know that AQN Algonquin has these wind farms, has some solar farms. Although I didn't do as much due diligence when starting a small position, and then I'll talk about the reason why I added to it and before letting it go. So it is also a utility, right? So utility generally are defensive stocks. You rotate into in the recession, but if you if you start, when this market starts downturn, you're catching it too late. So my strategy was at the middle of 2021, I saw the index being fairly high. I wasn't going to sell my growth stocks, but I basically, with extra cash I had, I decided to invest in a few utilities, as well as I had some telecoms, which I've also sold, given recent downturn in the growth stocks. And this is the have your cake and eat it too idea, right? So it is a high yield, dividend yield stock with growth potential. And if you just look at it, I mean, we're not seeing like tremendous growth, but for a stock that's paying anywhere between 4 and 5% from July 17 to 2022, you're seeing a 50% appreciation, right, on the stock price, plus all the dividends you have received. And the 2020 stock crash appeared to be short-lived, and compared to other energy-related companies. And a less so good reason for owning is because I had this Wealthsimple account, and buying U.S. stocks at the time was expensive on there, and I wanted to invest in my TFSAs to get tax-free savings on my dividends, right? So it's also popular among Canadians. Again, that's just anecdotal evidence. I added to my position after seeing Brandon Beavis cover the stock in one of his videos, and a lot of people in the comment section were quite bullish on that. Okay, so you look at that. Well, they're growing. Let me show you. They're growing the company, and the stock is also growing. So what can be wrong? Well, okay. So first of all, let's take a look at where this company actually does business, right? So I'm just going to read a bit of what the Algonquin does. It does energy generation, distribution, transmission, utility assets in Canada, United States, Chile, and Bermuda. But the vast majority, as you can see from the chart, and it's taken directly from their MD&A, is in the US, right? So even though it's a Canadian company with headquarters in Oakville, it is actually predominantly a US company, right? And the revenues, it doesn't matter whether it's the utility side or the renewable generation side, is in the US. And then the big difference between the two is that the renewable generation, they don't have these fixed contracts with customers, but they're also less regulated. Okay, so it's an interesting, depending on which side of the business you're more bullish on. And they operate, in California, New Hampshire, Missouri, Kansas, Oklahoma, Texas, which actually led to quite a disaster with the Texas winter storm in January 2021. I don't think the whole thing is sorted out. So Algonquin is potentially carrying some liability there. Yeah, so if you look at the dividend, it's also benchmarked to the US, right? So, they're paying US denominated dividends, and depending on the exchange rate of the day, you may get different amounts of Canadian dividends if you were to buy Canadian stock.
I have a question for you, Kuhn.
Yeah.
Is this company considered one of the dividend aristocrats for Canada?
Okay, I'm not so.
I believe
close.
so.
I think it's pretty close.
Is relatively young, and aristocrat don't you have like a record of increasing your dividend like?
I think 30 years or more.
30 years, yeah. I don't think so.
No, okay. Just thought I'd check.
But they have been increasing dividends steadily for a fairly long period of time.
Yes,
Okay.
so that's definitely the attraction, right? And then part of my discussion is that whether we think that could continue. Okay, so this gives you a better idea of what the utility business looks like. They're adding to their electricity generation from 20 to 2021. They're adding customers, although not a whole lot. I guess there's some kind of lead time that has to develop before the customers are signed on. But the utility generally are quite stable. And beyond supplying electricity, they also supply natural gas, okay, as well as water and wastewater. I think this is only in New York. And anyway, it's a small amount of their income. Okay, so then what happens to to the utility business, as far as I understand, is that when you have extreme events like the Texas power outage, Algonquin may be obliged to pull power from elsewhere at very high rates, right? But they can't immediately charge their customers these higher rates because they're a regulated utility. Now, there's a way to get around to that. I mean, the government cannot just let this utility for the entire bill, but there's a process in which the utility has to apply. At least this is what happened in the U.S. To raise costs, right? To ask the customers to pay extra for those months to cover Algonquin's costs. But this is subject to a government interpretation of whether Algonquin did everything possible to keep the rates down. Okay, so we do have some lingering risk, and I don't think the Texas thing is fully resolved. And then you have their most recent acquisition, which they took out additional equity and debt to acquire Kentucky Power, which is a coal-based generation company. And I guess the idea is to eventually turn it into more greener, where natural gas or renewable energy turn this, assets not performing so well around. Okay, so what I'm thinking is, in the light of the war with Russia and Ukraine, and the idea of prolonged sanctioning of the natural gas, coal, and oil from Russia, we're going to see increased input costs for these utilities. Okay, and especially natural gas, because Western Europe needs it, and it's still questionable whether how much of that rise in the gas price can Algonquin Power recoup, right, from customers. At least there might be a delay, which worries me about their dividend sustainability.
Okay, before you go on, let's go back to those risks for a second.
Yeah.
I'd just like to jump in. There's a couple risks that I see that aren't on that list. Number one being interest rate increases. This company's highly leveraged, and if you read their 10Q, they have a lot of their debt that's on interest variable rates. So rising interest rates with the amount of leverage that they're using can destroy cash flows, especially going into a interest rate hike environment when they have to start renewing a lot of this debt. And if the Fed or if the Bank of Canada has to become more aggressive on interest rates, this company will be paying a lot more to service its debt. Also, I'd like to point out, a lot of people, they say this utility infrastructure is sort of like a monopoly in some ways. I think that the rising interest in individual power generation is its biggest competitor in the future. So, you do maybe have a monopoly because you've spent all of this money on infrastructure in a specific area, but with battery technology and solar panels being installed on individual homes, I think that those rising, those are going to be the major competitors. So you don't really have a competitor of a big business that's going to come in and build all this infrastructure to compete with yours. But people turning to individual power generation with their own homes and with their own factories to save money. I've started to steadily see a lot more bigger factories building out these solar panels on their roof, investing in battery technology because they don't want to be subject to rising rates over time.
Right. So can you guys actually see the debt note that I just shared? Or are you still on the PowerPoint?
No, I can see it.
Okay.
I can see it on two different screens. Yeah.
Oh, okay. That's
your PowerPoint is your back. Yeah, because I've got double screens up. So
I only have one screen, so that's probably the difference.
Okay. So actually, I'll stop share, and I'll share again. I'll just put everything on screen too, so that way I can just pull things to it. Okay, so on the question of debt, yes, they do have quite a lot of debt, and it's so A is you have to look at when they become due, right, and at what amount. It seems to me our largest debt, with the exception of the senior unsecured note. I'll talk about the green equity units, which is a very puzzling one. But so we don't know for sure, but the latest maturity date is 2047, and it also depends on whether those debt interest rates are locked in, right?
Yeah, if you scroll down, is this the 10 down here?
This is the 21,
there should be under
quarter.
risks. Go scroll down a little bit more.
Yeah,
under risks. It'll say interest rate risks.
Okay,
long-term
well,
debt.
they will all
And
they will
it
always
shows
be
you
interest rate risk,
you
right?
the effect. No, it shows you the effects that it would have on their variable interest rate debt. I think it was page 53.
I did your homework, Tom.
Yeah.
So 53.
I think it was around 53. I was having problems with my internet, so I closed it.
Yeah, it's actually, they don't have page numbers on this, which is very annoying. Like, you know, number your statements, man.
Yeah, I think I downloaded
This
it as a
this
PDF.
is such a nerd problem. I love it. When you're
Yeah.
complaining about the 10K,
Yeah, I will. We're gonna let Tom. It's because
Yeah,
certainly that's the.
I don't have the numbers in front of me. I was having
Yeah.
problems with my computer.
Okay, so
but it does
what-
list that there is quite a bit of they have some variable interest rate debt that will suffer.
Yeah.
Also, like, you know, if you look at the rate of revenue growth and the rate of debt and equity growth, the debt and equity is growing at almost double the pace that revenue is.
So
Yes,
it's really not,
yes.
the growth
Yeah,
rate's
that's-
really not sustainable, is what you're saying.
Yeah, that's why I you know why I said so. So let me see. I'm gonna change the.
I just want to build on something Tom said a minute ago while you're getting your presentation ready, if you don't mind.
Yeah.
Tom was talking about, like, you know, how people view infrastructure as sort of a positive benefit. But I don't know if I agree. I think, like, the logic is in part too that if the company goes bankrupt, they could sell that infrastructure. But and you see people like compare it to, say, like a company like Google that has no infrastructure to sell. But I think what that actually does is it just really lowers the margins of the company because they have to pay for all the debt to build that infrastructure in the first place. And then this idea that, like, oh, the company is going to be able to recoup share value and give it back to you by selling infrastructure. I highly doubt that they're going to be able to sell that infrastructure on, like, dollar for dollar value. So even if, like, the book price of the stock is $80, which I'm sure it's not, just as a hypothetical example, I doubt if this company was liquidated, you would actually get $80 back.
So
and the book value per share has stayed relatively stable, but, like, because they're diluting and the book value per share isn't really moving very much over the past 3 or 4 years. And I think we've seen I can't, like, almost 17 or 18, like since 2017, the net debt has almost doubled. So as a share count.
yeah, well,
While over that same period of time, I think it's like around 50% revenue growth over that same 4 years. So you've grown revenue by 50% over 4 years, but you've doubled your share count and your debt.
Yeah. Yeah, make a great point. So yeah, so if we're just looking at ratios, right? So we can I actually had this charted out, some of the charted out, but what you're saying is the total debt to equity.
Yeah, look, no, just look at total debt. So
debt assets.
pull up on just a debt on the balance sheet. Go to the balance sheet. Forget the ratios for a second. Go to the balance sheet.
Just long-term debt.
Add long-term debt. Add revenue. Common stock. Add to it.
The total liability has
common stock and debt
almost doubled.
Has almost doubled over the same period of time that revenue has grown by, I think like 50%.
Right. I feel like what Tom is trying to say here is that, like, they're using debt to fuel the revenue growth, but the amount of debt they're having to use to grow the revenue is not.
Oh yeah, you know, that's how they grow, man. So it's not an organic growth approach. They're very acquisitive and they like to buy distressed assets. You know, for example, this Kentucky power plant. Actually, you know, if this thing doesn't go through, they're on the hook for $865 million termination fee. So yeah, so they like to buy these assets, turn them around, because superior management is also the leverage their superior credit rating to get better you know, like interest rate on the debt they issue. But it is quite a tightrope to walk, right? Because each time you increase revenue, you're issuing additional shares, at least a couple times last year, and debt, additional shares and debt to fund that growth. And I'll show you that the profitability has actually been declining. So one thing I, you know, say, okay, so what about natural gas, right? Just follow my thesis of what happens this year if natural gas prices stays up there. Now we don't know what how much of their power generation, right, for electricity generation, the utility business is green. I doubt much of it is. They have hydroelectric, but to provide stable power outage, like power output, they can't do wind and solar, right? Because those are inconsistent without sufficient battery storage capacity. So I did. So yeah, they said we'll have this solar generated power. We just don't know how much how the revenue derived from there. So what I did was basically chart out the regular, so the utility side, their operating margin. Actually, I think this is the gross margin. So gross margin take into account the cost of producing that electricity, which means the commodity they're buying, right? So as you can see, the orange bars are natural gas. The price goes up, gross margin goes down, right? So that's it's a 15% correlation, negative correlation. So I'm expecting the gross margin to fall for 2022 for the utility business, which doesn't bode well for operating margin, obviously. Okay, so let's look at the growing revenues. So I again separated out these two businesses. You can see the gross profit as percentage of regulated service revenue is actually pretty healthy. I think for utilities, most of it's infrastructure, so it's not surprising. But they're able to keep it around the low 70s, high 60s percentage. But the operating margin, when it topped in 2017 at 26%, has fallen back down to 20%. So I think this is related to just they have a hard time getting the parts they needed because it's a global supply chain to actually build and renovate these power generation facilities. Okay, so they're going to pay more for shipping, pay more for the parts, and so there'll be higher amortization. As for the renewables, it looks even worse. Is that okay? So renewables, obviously, you get wind and solar for free. Also hydroelectric, for free. It's not surprising the gross margin is extremely high, but the operating margin has fallen off the cliff in 2021. Okay, yeah. So and what's worse, I think, is well, it depends on why you invest, right? The percentage of the revenue as a percent of total revenue for the renewable business, which has very high gross margin, has been going down over time.
Yeah, I've been really paying attention to this sector because I think it makes sense to invest in renewable energy for a couple of reasons. For one thing, obviously, it's a trend in itself. People want to go green. It's popular politicians to want to go green. I think renewable energy will be the future to some extent or another.
Yeah, but if you look at the companies like oil and gas stalwarts like Fortis or Enbridge, they all have their kind of their renewable project, but they're just not willing to grow the business at a very low return on investment capital.
Yeah, and I think as another side of this too, as electric cars increase in popularity, I think we'll have increased power demand. So buying a utility company that sells renewable energy, I think it makes sense in theory.
Yeah. But you need a lot of battery storage.
Yeah.
Yeah, and maybe the cars can be part of that storage, story. But go ahead.
Yeah, I just say I've been following this for a while, and I haven't found any companies that really seem to be a solid investment in that sphere, and it's part of why I've stayed out of it.
Right. If you look at Next Era, like they pay next to no dividends. They're like primarily a solar business, like located in Florida. They're growing their revenues, taking on low return on investment projects, but they have low cash commitments, unlike AQN. So here is something that also worries me. I've done a comparison between Algonquin and Fortis since they're all Canadian companies, although like Algonquin is not obviously not really that Canadian. So take a look at the return on equity and return on common equity. So the spike you see in 2019 and 2020 is when they sold investment, at a profit. So you have to give credit where credit is due. Managers made a smart decision, and they were able to sell for profit, and that gave them all the cash to additional acquisitions or even to fund their dividends. That's great, but those are not recurring, right?
Mhm.
What I've seen is you look at the return on assets, right? Because return on assets excludes those sales of assets, and return on assets has been falling, right? From just above 2% to below 2%, and the return on capital says the same thing. Now, if you look at Fortis, yeah, they're not doing great either, but they're very, very stable compared.
That's really good. So we were talking about a normalized PE in our pre-conversations, you and I, Kuhn. And I looked at like their earnings around that 2021 period. But it looks here like a lot of the earnings that we saw growth on might have been short-term cash flow infusions, not long-term. Would that be accurate?
You mean the growth?
Yeah, so the growth we saw in that 2019-2020 period in earnings was a lot. And it's gone back down.
Growth in what? Sales or earnings?
Just earnings.
Oh, earnings. Yeah. Well, they sold assets, right? Just like your own real estate business, and somebody give you like an offer you couldn't refuse. So you sell one building, you realize a huge capital gain on that, gets a lot of cash. That's great.
That might have been why it looked like such a darling in the valuing community for a little while, because it looked really cheap. Well, those short-term earnings books.
But
those aren't reoccurring.
Yeah, the market has now 1 year to adjust to 21 numbers, and again, I think the market may be slow to adjust to this.
I'm looking at the estimates in terms of future earnings.
Yeah,
and we have here on IB, it's saying the 2026 numbers. Their average estimate is around 96 to 97 cents.
right.
That's actually way higher than Yahoo Finance has it, to be fair.
But that's in 2026.
Yeah.
Oh, okay.
Yeah, right? I don't know. That's higher than my estimate. But
so like even if they can hit that at a dollar, like being on the very high end in 2026, what's a PE for this?
Too high. And I can get to that when I go over my PE part, but like that's too high. Like
sure. Okay, so let me just get through these couple graphs and then we'll talk about earnings. So I'm there as well. Like back to what you were talking about, Tom, with the additional debt, right? So you can see this just from the interest coverage ratio. So if you divide the EBIT, earnings before interest and taxes, and divide by interest, right? So you can see the coverage ratio has gone down from close to 3 to just around 2. Sorry, actually no, it's below 2, right? So but
that's also
look at the
because
left
interest
axis.
rates are at rock bottom.
Yeah, that's falling, and the interest rate at rock bottom. Yeah, what if the interest rate goes up and they can't reduce their debt? This coverage ratio is going to keep falling. That gives that's one of my primary concerns about the dividend sustainability, because I don't think they can fund the dividend if the interest they actually have to pay goes up. Now the current ratio, you can see it's also falling, right? That's generally a sign of the deteriorating liquidity in the business, going from above 1 to
if it's below 1, then that means that they're going to have to raise capital.
It's below 1, yeah. And fixed asset turnover, basically, if it's a fixed asset intensive business, you want to look at that as the efficiency. That's also been going down. Now, but that could be why they're buying distressed assets. Obviously, when you incorporate those assets, you're not going to realize the return right away, right? But time is not on their side. Like if you want to keep the dividend going, and whereas you look at Fortis, is very stable, right?
I would like to add though, where the current ratio on some of these companies can really be deceiving is when you have long-term debt that goes into the current assets that's going to be renewed, makes the current ratio look a lot worse than it necessarily is, right? Like if you take $1 billion of debt that you're just going to refinance, but it's put into the current liabilities instead of the long-term liabilities, right? So
so you're saying year to year?
No, so like every year. So if you have this large amount of long-term debt, right? Over certain years, some of that debt's going to move from long-term debt into the current liabilities.
The current portion, which is due within 1 year.
Because it's due within 1 year. So that's going to be renewed, right, in that year. So it's not necessarily going to be coming out of their current assets, right? It's not going to be paid off in full out of their current assets. It's going to be renewed and put back into the long-term liabilities. So that could skew the current ratio.
Right. Yeah, I agree
Know
with
what I'm
you.
saying?
The current ratio can keep going down as more of these debt becomes more current.
Yeah,
basically.
because if you have a large amount of debt that you're going to refinance, the
Yeah.
current ratio is going to be destroyed in that year.
Okay, so this is my last slide. Basically sums up my my take is that, okay, I'm looking at this dividend. I think that the stock will regrade if they can't keep up with their dividend. Okay, so and the valuation will come down. I'm not saying it's not investable, but I'll probably look at this, once they're in a, Canadian dollars, $14 ish. But I'm looking at the free cash flow from operations, right? So like they don't have to do any acquisitions, but they have to kind of maintain their current infrastructure. And this is not counting the potential sales. Of course, you can get more money from there, but it also erodes your revenue base. So the cash available to common shareholders, removing the capex and removing their dividend to preferred shareholders, it's been negative for past 5 years, right? So they've been issuing more debt to keep this up. And if you look at the EPS each year and you compare that to the dividend, the dividend is much higher than their actual earnings. Of course, earnings includes amortization, but this just doesn't bode well if the company wants to reinvest, right? And certainly it's not going to grow.
No,
And,
because what they're doing in their defense, even for something like this, free cash flow is sort of, I don't know if that's the right metric because of the amount of capex that they have to do to grow the business. Your free cash flow is going to get destroyed, right? Because it's a high capex type business that if they're buying these assets using debt and equity and then they want to transform them, it costs money. But yeah, at the same time, like,
so you want to see something kind of a little bit.
The growth of debt and the growth of it puts this into a high risk.
Yeah, you see what's
they're
interesting?
building a house of cards.
Yeah, so capital expenditure, it's going up, and say, well, maybe some of it's acquisitions, which is kind of interesting, right? They used to break out their cash acquisitions from their capex. And I actually had to go into the statement to actually kind of break up this 1.3 billion to what are the acquisitions and what are the capex. I don't know why they did that. They did the same thing on the statements, financial statements as well. Yeah. So yeah, I'm done. So I'm gonna revisit my investment thesis at the end of it, but I'm quite eager to hear what Nate has to say. I think he did some work on the earnings.
Yeah, so I've business stock I've been watching for a long time, and I have some strong opinions, but I actually think, because I first want to look at this from the lens of like a dividend investor, and why someone might want to buy this, and then why I think it's still a bad fit for them. But we often talk about growth stocks, and I think Tom is our resident growth investor. So maybe Tom can explain first why this is not a good stock for a growth investor. And I can come in as the because
they're not growing at a sufficient rate. They're growing at 10%, and the way and it's more about not only that they're growing at 10%, 12% is a good thing in most cases, but like the way that they're growing and the way they're using the debt and the equity adds on a whole lot of risk. Like they have about, I think, 150 million in cash and like $6 or $7 billion in equity. I mean, in debt. Like I like to invest in companies where they have more cash than debt.
What's the debt equity ratio? Did anyone look that up?
It's actually been okay because they've been issuing equity, right? But that's the thing. If they want to keep up with their dividend, dividends per share, they don't.
I don't like debt to equity. I like debt to cash. How much cash do they have? Because like equity, so like I think they have almost $1 billion worth of goodwill in their equity. That can disappear in a second. If this company becomes insolvent and the creditors start selling off its assets, how much is that equity worth? Right.
Well,
what's the book value per share then?
Yeah,
the book value per share is around, I think, $6 or $7.
Yeah, I guess people would say, the government's not going to let a utility just kind of go kaput, and I don't think they are necessarily in the shoes to.
My argument against that is that just because the company goes bankrupt doesn't mean that the utility assets stop functioning, right? It just means that the creditors will get the assets and sell them off to different utility companies. That doesn't mean that those those utilities are just going to stop functioning. It just means that the transfership of ownership of those utilities is going to go from the shareholders to the debt issue to the people who issued the debt, and then they're going to sell it to the highest bidder or the lowest bidder, depending on what the macroeconomic situation is at the time.
Yeah, they have 300 million of dividends paid in 2021, and they only have 126 million of cash on hand. Now, the cash is going to come from the rates paying customers as well, but that goes back to some of the risk I talked about. If they can't get the regulators' approval to charge their customers extra, they have to find some other way to come up with the cash.
Yeah, I think, you know, I have some stats here I'm going to share, but I think before I get into it, I think there's a very specific type of investor who's buying AQN. And I think there's become this portfolio that's really popular for retirees that is what is viewed as low risk dividend paying stocks. And AQN on the surface, it looks like a low risk dividend paying stock. In the past, its PE has been low. Its yield is moderately high, but not aggressively so. It has a long history of increasing that dividend, and the share price has been relatively stable with very little volatility. So to a retiree on the surface, I think that looks like a really good investment. I'm okay. I like to buy stocks like this when I think they're undervalued at a deep discount, because I think it's a safe way to grow cash. And I think it's also a safe way to hedge against volatility in a growth portfolio. Well, most of my portfolio is growth stocks.
Yeah.
And I use a stock like AQN to lower my risk, but I don't think AQN actually fits that profile, and I'll get into that. But.
Yeah, there's actually interesting play on AQN stock. It's called AQNU. That's related to the green equity units I talked about. I'll chime in briefly at the end for people who are still interested. Yeah, it's a very peculiar thing.
Yeah, I actually think it's a solid strategy, to be honest, to go with the dividend aristocrats, to find low risk companies that pay dividend. If you're a retiree and you just want that cash flow, I'm sure Tom can explain to us why the math on that doesn't actually work out.
That's where I was gonna go next.
I think like psychologically, it could be really beneficial to an investor to not have to sell any shares to recoup profits, so that they can just live on the cash flow and not worry about managing their stocks, and then pick stocks that are relatively safe that aren't going to go down over time. I just think AQN doesn't fall into that category the way it looks like it does, and it probably has historically speaking, but I don't think it any longer fits that case. So I'm gonna just share my screen with real quick. And my biggest problem here is that I think it's extremely overvalued. It says host disabled.
Oh, I'm sorry. Okay, I've been a dictator.
That's okay.
Putin style.
Okay, Putin style. I love it. It's topical. When people watch this video 10 years from now to get our valuation from 10 years in the past on AQN, they'll be really confused about it.
I love it. You have it in like in a text file, you know, it's old school.
I know this is very visually unappealing, but I was a little rushed as I was doing it, and I apologize. So when you look at like relatively stable companies, I think it makes a lot of sense to look at the historic PE, because I think people are willing to pay a premium for a safe dividend company that's paying a cash flow that might be slightly higher than its traditional value in terms of like what, you know, Jake would tell us is its value at an intrinsic level. Like, for example, BCE, which is Bell stock, it typically stays right around a PE of 20. And it dipped well below that in the summer. I bought it. It went up 17% in like 2 months, and I sold it. So I think like those kind of value plays are really easy to do, and they make a lot of sense. With this industry, like AQN's average historic PE is roughly around 20, and the industry average is also around 20. So to me, that says that the price I'm willing to pay for this stock should be about 20. I think the whole sector for some reason is overvalued right now. It's sitting around 29. That might be a result of the fact that we had that windstorm in Texas, which damaged earnings for some of these companies. I'm not entirely sure why the PE is so much higher than normal right now, especially considering maybe it has something to do with the rotation into value out of growth we've seen. I don't know. Mm-hmm. But the current PE of the company is 37, which is really high by any standards, I think. And if I'm paying 37 for a company, I want to see really good growth. I want to see high growth. And honestly, there's a lot of growth companies I would pass on if they had a PE of 37. If
Yeah.
Google
Well,
was at a PE of 37 tomorrow, I wouldn't buy it.
that depends on whether you think extreme events like the Texas windstorm is going to happen again, right? Because that is the primary reason why AQN's earnings this year is so low.
So I'm gonna get to that though.
Yeah.
So but part of my logic here is that the analysts don't seem to think that the growth is gonna, or the earnings are gonna immediately recover, which is concerning to me. So if we look at like a normalized PE, we get I took an average of their earnings over the last 3 years, and I got to a current PE of 14.67 if we normalize earnings, which would make it 27% undervalued. But nobody seems to think that the earnings are going to recover overnight, which makes me worried. The average analysts are predicting 9.6% growth in earnings over the next year and 10.42% over the next 5 years. And the analysts have been surprisingly accurate at predicting the earnings of this company. They predicted the 50% drop in earnings that we saw, for example, and I didn't know why it was going to drop 50% in earnings, but that was why I actually avoided buying the stock, because the analysts were predicting that 50% drop in earnings. So it's got a current earnings of 52 cents, which then part of this, it might be the Texas storm, but as Kuhn pointed out, they sold some assets this year too.
Well,
right?
in 2019 and 2020. So,
okay,
so that's why if you normalize the earnings, it seems the earnings is quite good. But if you just look at 2021, it's terrible.
Yeah. Okay. So that makes me concerned that they're not going to be able to get back to a stable PE anytime soon. So I think this normalized price to earnings ratio of 14 is unrealistic. If it was at a price to earnings ratio of 14, I would be fine buying it.
Yeah, I agree.
But at a current PE of like 37, that puts them 86% overvalued by my calculations. I mean, I'm a school teacher, not an analyst, but you get my point. And even if we look at their growth rate, like their growth rate just doesn't justify this, especially when we consider, as Tom pointed out, that their growth is entirely powered by debt. So like, if we look at their current growth, like the predicted rate is 10% over the next 5 years, 9% next year, and their last 5 years, they averaged 17%. But as Kuhn pointed out, there was some one-time infusion of cash flows into that. So I got a mean growth rate there of 12%, which leaves me pretty happy putting that down as their growth rate. Although I don't want to buy growth that's being entirely fueled by debt and nothing else personally.
Well, and equity and dilution.
Yeah, and equity dilution. Like none of that seems good to me. Like that's not growth that's worth it. So I have we look at this as a PEG. This is 3. So we're looking at a stock that in terms of its valuation by PE looks similar price to Microsoft. And if I have to choose between a stock like Microsoft or AQN, I'd much rather pick Microsoft because I think that's a better company. I think it has less debt per the company. I think it has more sustainable growth. I think it has more growth in its future. There's no way in heck I'm buying AQN. And even if we look at it from like the type of portfolio I was talking about earlier, where you want that stable dividend growth over time for a low price to earnings ratio with relatively low risk, I think there are a lot of companies with a lot less risk and similar dividends. I think you could go with almost any telecommunications company. I think you could go with any of the 6 Canadian banks, or I think you could go with an ETF of those types of assets. It wouldn't even be my first choice of an electric company, if I'm being honest. So it's a hard pass for me personally. And that doesn't mean that nobody should buy it. I'm just saying I'm personally not willing to buy this company.
All right, let's hear from Tom.
Yeah, here, I'm gonna share my screen now for a minute.
That text file is very informative, Nate.
Okay, so this here is the US dollar version one because I don't pay for Ticker Terminal. But so if we look here, this is the chart that I was telling you about. So from 2017 until today, I ran the numbers on this. Let me just pull it up on my phone for a second.
Is this revenue?
So this is the bottom line. We have revenues, and then we have net debt and common stock on top. So we're showing that from 2017, revenues were around 1,497 until today, or December 31st, 2021, up to 2212. So that gives us a compound annual growth rate on their revenue of 9.8 on average from 2017. Now, if we take their net debt and their common stock, so they're diluting at so their net debt is growing at a compound annual growth rate of 18.02%. Their common stock is growing, the shares outstanding is growing at a rate of 17.41 compounded year over year over the last 3 years. So, you know, the dilution in the debt is dwarfing any revenue growth that they have. And it shows when you look at their book value per share. Like book value per share, yeah. So over the past, since 2017, the book value per share has climbed a little bit, or tangible book value per share. Like it has climbed a small bit, but I don't think anywhere near close to like what it should be.
Considering the growth rate.
Considering the growth rate, yeah.
Yeah.
The thing is, that book value, it could be tricky because if you
the
buy,
US versus Canadian.
Well, if you buy a lot of assets, you may end up in a situation where you overpay, and that book value gets recorded as goodwill, which may not be any good.
Yeah.
So
and they've got almost $1 billion in
book
goodwill.
value per share number. Yeah.
I think if I could just very quickly summarize what Tom and I are saying, is it like on the surface, the company looks like it's doing good things. It looks like a safe dividend play, but I don't think either of us actually think it really is once you look under the hood.
Yeah, that's my primary fear, is the stock gonna get re-rated once they say, well, we have to cut the dividend. So yeah, let me just see.
Yeah, like to wrap it up, like what Nate was saying is, a lot of people, they think, oh, if I get 4% dividend, it's easy, or 4 or 5% dividend, it's easier than selling stock. And I feel like I have the same amount of shares, but like in reality, the reason why I don't buy stocks just for the dividend, not saying that I won't buy a stock because it has a dividend, is number one is tax efficiency. When you're paid out a dividend, if you're not in a retirement account, you're going to be paying taxes every quarter. If you sell the shares, so let's say if you were to invest in like an S&P index and just sell 4% of your shares, over the long period of time, you will have actually more money.
Yeah,
this stock has not outperformed the S&P. It doesn't seem like it will outperform the S&P. Most people are better off buying the S&P index and then selling 4% of their shares, or selling, I think S&P pays what, a 2% dividend or something like that. Yeah. Sell 2% of your shares and take the 2% dividend if you're a retiree. If not, you can compound at a faster rate, not having to pay taxes on those dividends every year.
And I think that's a really good point, because if you're going to be like a passive style investor who's using AQN in their retirement account, because let's be honest, people buying AQN for the most part, they're retirees and people looking to like retire early on cash flow. Like you have to compare it to another safe investing strategy. And obviously, probably the most back-tested safe investment strategy, passive investment strategy, is buying the S&P index. And how does buying the AQN stock compare to the S&P? It compares terribly. So like, why are you using a passive index investing strategy that doesn't work when back-tested?
And then what happens when bond rates go up as well? You're sitting at a 4.5% dividend, and most of these people are buying it just for the dividend. So, in a world where the 10 years at like a 1.4, 1.5, okay, you might say, I'll take this and take the 4.5% yield. But if the 10-year goes up to 3 or 4%, which is a strong possibility, how attractive does that risk reward look on the 4.5% dividend, with the risk of the share price going down as well?
Yeah, I love doing swing trades and picking stocks, but like that's because it's fun for me. I really don't think the average person should be picking stocks. And if your thesis for AQN is that it's low risk, I think you need to revisit that thesis.
Yeah, well, okay, so let me just play the ball a little bit, because I think, it's just three grizzlies just kind of gnawing at the stock. So you've seen my thesis and why I don't think, why I sold most of my shares. I kept one share to track the position. But so what will be a remaining bull thesis? I think, well, okay, so electricity price will hike, and they'll be allowed to be increased. Will boost revenue for the renewable business, right? Because we know that their gross margins are very, very high. So in terms of kind of like, okay, what if they get into trouble? Well, hopefully, there'll be major subsidies by the government to signal that, okay, we're going to invest in more in green energy, because, from the current cash flows, I don't see the growth to come from, organically, right? And maybe they have other gems in the investment portfolio can be sold for a gain, right? So the company has demonstrated some ability in the past to do this. So you can't really discount that, that possibility entirely. Sorry, go ahead, Tom.
So in terms of electricity price hikes, I don't necessarily agree, because a lot of these places have to be approved by regulatory boards run by the government. And in times of high inflation, government has to show that they're not letting prices go up. So I don't feel that they're going to be as easy to approve price increases in these regulated industries, because that's something that they control. There's a ton of other stuff out there causing inflation that the government and the regulatory bodies don't have direct control over. So I think that they might prevent companies like this from raising rates at a higher level, just because
why do you have
one
to
lever that they
both
can
horns,
pull.
Tom? Like,
That they
I was just
pull.
making a bold thesis.
As a political junkie, I just want to jump on your point there too. I think there are certain stocks that are so likely to be owned by politicians that they're less likely to be regulated, if we're being totally honest. Like pretty much every Canadian who has a lot of money is going to have some money invested in telecommunications. So you see that, like Canada, we see very little regulation on the telecommunications companies. I don't think that's a coincidence.
Yeah.
Whereas like AQN is a little bit more of a smaller play. Yeah. So I don't think it's not going to be as hard to regulate it, because it's not like half the politicians own the stock directly themselves.
Yeah. Okay, so I'm just going to end this with a little bit of fun information. You can see this as a potential a value play or a sign that AQN has some more problems. So in 2021, they issued these green equity units. For all intents and purposes, these look like convertible debt to me. Basically, convertible debt is it offers a coupon, but also an option to convert these bonds into equity at certain rates. When some time hits or some other target hits. So basically, they're offering a very high coupon. 7.75%. Wow, right? Like, think about getting dividends. What about this? Well, it seems to me that, they pay an interest of 1.18%, and there's a contract adjustment payment, which I understand to be maybe just like funds they would give you to let you purchase equity for cheap, as opposed to just giving you the money. I try to understand, like I look at the regulatory filings and the 10K. I couldn't understand it, but like they say, this interest is there, so it has to be paid to you some way, but maybe in terms of like points as opposed to cash. So it's very interesting is that par value of $50. So by 2026, you can convert up to 3.33 units or 2.778 units. So basically, if you take the par value and divide by those conversion ratios, you get, this is the US dollars, right? US dollar share price of anywhere between $15 and $18, right? So if the stock is trading at $19, you can actually buy it at $18. Think about that, right? And just for your information, the AQNU, so this is actually traded in the US. I don't think it's available in Canada. This $50 convertible bond is trading at a discount to the par value at $46.92, right? Where like actual AQN is trading at $14.79. This is March 15th. So the implied value, right, is if you just take the 46.92 divided by the 2.778 or 3.33, it's anywhere between $14 per share or $16 per share. So if you are bullish on AQN, you're better off buying these AQNU, because that gives you actually more shares, but you are kind of locked in because this is not a very liquid stock, and I don't think a lot of retail owns it. And to me, that's a bearish, because I think institutional investors are actually pricing AQN lower through this AQNU equity than the current market price.
That's really cool. That's really fascinating. I don't know. I'm just
Yeah.
nerding out over that.
Yeah, and then why did they have to issue these green equity units to begin with, right? Like, just
companies do this weird stuff. You see so many big companies. I think they want to issue debt and they don't want to do it into a public way, so they make these weird shares. Like Ford has done something similar.
Yeah.
I think Rogers has done something similar. They have all these different types of shares out there that you can buy.
Yeah, I think like just there's so many better options given the valuation, given the growth rate, given the risk of the debt, the amount of cash and stuff like that. I personally, I don't like to invest in companies where debt and dilution is going on at the same time that they're raising dividends, right? Because it feels to me
you can't have your
like
cake and eat it too.
you're borrowing money to pay the dividend. Cut the dividend and reinvest into the business. You know, I've always had, if a company's paying a dividend, it means that they have no better way to reinvest that money within the business to get the shareholder a higher return, right? So if there's no way you can reinvest the money, but you're taking out debt to reinvest, right, while paying out the dividend, I don't think that really makes sense to me.
Yeah, if you love utilities, I would suggest, based on limited research, Fortis may be a better buy, and even Enbridge. I'm looking at Enbridge, and you think about the pipelines that they have. There's no substitute, right? So the North American producers will be dying to get their energy out to ship to Europe because they get much higher spot prices over there, right? So they'll be competing for capacity of Enbridge, although some of these are long-term contracts, so they can't just say we'll take the highest bidder. But I think it's at least in the next few years, Enbridge will be much safer play, and it pays a higher dividend than AQN.
Yeah, I'd probably go with Enbridge too, although I haven't done enough due diligence on Enbridge. I want to say, like, I think there is a place in a growth investor's portfolio or a young person's portfolio for a dividend stock. I think dividend stocks do lower your risk. And there's a natural risk reduction point to dividends, I think, that sometimes gets glossed over. Like, let's say a stock goes to zero for hypothetical reasons that aren't reasonable. If you have the dividend, you can still recover your losses, right? Even though it's like I think we all own Facebook. And Facebook is doing buybacks, which, as Tom has pointed out, is more tax efficient. It makes more sense theoretically. But like, if Facebook stock never recovers and they don't pay a dividend, we don't really have any way of recouping those losses. But if
they can cut their dividend if the board of directors approve of it. Although it's very much of a frowned upon, like a company would do this because it really kind of leave a sour taste in investors' mouths, right? But Disney has done that.
And I think that
they have actually
hurts
successfully navigated the narrative.
Yeah, I just think like personally, I use dividend stocks to mitigate risk, and that I view dividend stocks as a lower risk stock. And when I think the market is really overheated, I dollar cost average into dividend stocks. And when I start to feel more bullish on the market as an overall, I start to dollar out cost average into higher risk companies. So in January, I was dollar cost averaging into dividend stocks, but I still wouldn't have picked AQN just because I think there are so many better dividend plays out there than AQN.
Yeah, I agree totally. I use some of the lower growth dividend stocks that are more safe and consistent as sort of like a cash placeholder when I don't want to hold cash, because you're not going to get nothing holding a bonds. So at least you can get a little bit of yield, and the stock's not likely to drop 50% tomorrow or 30. You might get a 5 or 10% drop in some of these more stable cash flow companies, but AQN is not that.
100%. Although I think even 20% drop in a stable dividend paying company is reasonable.
Yeah, because even if you're holding a dividend company and getting a 4 or 5% yield, and then let's say hypothetically that dividend stock falls by 15 or 20%, but you have similar growth stocks who have fallen 50, 60, 70, 80, 90%. Even to cut your losses on those dividend stocks at a 10, 15% loss, to rotate into a stock that is 80%, 60% or more undervalued. The risk reward sometimes makes it worth it to take those losses.
I used to do that with Microsoft and Tesla. and then I sold Microsoft and bought Tesla, and Microsoft went out like, to gain like 30% while I'm not holding the position. So there's no guarantee to win out. Maybe next time I should just pick a more like regular utility as opposed to that. But yeah, like like I think these type of strategies can give you a little bit more alpha on the side. They're not absolutely necessary, if your cash flow, living expenses not dependent on the investments, right? So we're all trying to squeeze out a little bit more money from our portfolio, but things can go wrong, and the best strategy is still trying to identify the best companies and stick with them thick and thin.
I mean, Tom just described exactly my like investment style right there. Like, I just rotated out of value into growth like this week.
What did you
That's what I've been doing over the past month. I've been doing that as well.
Yeah, I just sold a whole bunch of dividend stocks to buy growth stocks this last week. But like at the same time, like that's obviously not what like the average person should be doing. That's obviously not what like a safe investor would be doing. And it's obviously not what like any investment guide would tell you is a safe and reasonable practice to do in investing. In fact, I think probably almost any qualified expert would tell you to dollar cost average into ETFs. But we're on a stock picking show. So if you're watching this, why are you watching this if you're dollar cost averaging into ETFs?
Yeah, and I think as a stock picker, you gotta. I'm not spending all this time doing research to get an 8% return.
No.
And if you're gonna spend the time, then I think you have to have a higher threshold of what you're aiming for as a return than a 4.5% dividend, with not huge prospects of share growth. And then you have the risk of the debt, the risk of the dilution, all of these different risks for that 4.5%. When inflation's at 7%, right? You're losing money on a real basis on a lot of these dividend plays or safety stocks with inflation. The way
I like that. That's a hot take. I'll actually snippet that clip out and put it at the beginning of the video, right?
Yeah.
So that, lead in the video with a little bit more drama, right?
Yeah.
Supplies the drama.
I
actually, any last words? And
I just want to build on what Tom said. I think some of these stocks that are like viewed as like safe dividend stocks are growing at rates lower than the inflation. And I would point out, like, if you're looking at the growth rate of AQN, I think you have to subtract the growth rate of the debt, which basically means it has no growth rate. Like, you're not really growing your wealth, I don't think, holding a stock over that's a long term that's growing its earnings slower than it's growing its debt.
Yeah, I definitely agree. Like, yeah.
All right.
The accountant in the room clearly disagrees.
Oh well, I wouldn't be quite so.
Well, I think
sure,
that,
but I don't think I have a good retort for you, and I want to agree with you. Although look at mortgage, Canadian mortgages, right? People who made money through real estate. Are you saying like there shouldn't be growing through debt, because that's a very favorable government policy to let people take on debt and grow their assets, and a lot of people have become millionaires, tens of millions through that way, right?
Yeah, so like the real estate rebuttal is a pretty great rebuttal. I won't lie. Like, I was actually just looking at the math on real estate.
Yeah, like,
but I think like as a company, like you would hope that the growth rate of the earnings is higher than the debt, wouldn't you?
Well, earnings can be choppy, right? So
Yeah.
we may be in an extraordinary period for AQN. Maybe we're all wrong, right? But that's not the risk that I was willing to take, given my investment thesis. So yeah, it's a great talk, and I think I learned a lot from the talk, and I hope to do so next week again.
all right.
Guys.
All right.
Good night.
Cheers.
Bye.
Bye.